Kentucky, Mr. Barr, for 5 minutes.
Thank you, Mr. Chairman. Mr. Zuluaga, a question for you. Many small banks and credit unions in my congressional district in central Kentucky have told me that overzealous supervision, overregulation, and higher compliance costs stemming from the Dodd-Frank Act and other regulations have forced those lenders out of the small dollar lending business, out of the consumer lending space altogether. This has had the impact of pushing many borrowers to payday lenders and other forms of non-bank and non-credit union lenders. Is the answer for unbanked, credit-challenged borrowers more regulation and banning higher-cost products? Or is the answer more competition and choice through financial deregulation? And as you answer that question, keep in mind the testimony from Mrs. Standard, who said that competition is not the answer.
Thank you for the question, Congressman. I think the answer is clearly more competition and more choice, because that drives prices down for consumers. It creates options that are more well adjusted to exactly what it is that they need and want. And it also encourages continued innovation so that whatever negative features are in a financial product are no longer present there. In the particular case of small dollar lending, it was mentioned before that there was a 2013 guidance from the OCC and FDIC that led banks to retreat entirely from the small dollar lending market, and this is in keeping with a general retreat of banks, as you suggested, since passage of the Dodd-Frank Act.
So you're telling me that banks and credit unions have retreated from this space after Dodd-Frank?
The evidence that I've seen for banks, decidedly so. For credit unions, I'll have to get back to you because they do some different types. They offer some type of alternative products, but obviously they don't reach everybody.
I can tell you that credit unions and small community banks have told me that they have exited consumer lending post-Dodd-Frank and because of an avalanche of regulations. But let me explore this idea of an APR rate cap. In 2018, a major super-regional bank in the United States began offering small dollar short-term loans. The program has a limited scope to those customers with a current banking account. And even with the pricing advantages of lower capital costs and additional risk mitigation employed by that bank, in order for the program to be sustainable, the bank is charging interest rates between about 71% and 88% APR, more than double the 36% APR rate cap that has been advocated by some. If a large super-regional institution with all of its market advantages and economies of scale can't make a 36% APR work, why is it realistic to think that a state-licensed or non-bank lender could do that?
I don't think it's realistic, Congressman. And in fact, I think we need to think about the small dollar lending space as something of a spectrum. There are products for prime borrowers that carry low rates because they have a credit history and they have a record of paying back their debts. Some people, for various different reasons, don't have necessarily access to such low rates, and removing the options that they have, the people that will accept them as borrowers, doesn't make them better off. It makes it difficult for them to build a credit record, makes it difficult for them to survive emergencies, and so on.
Reverend Dr. Haynes, thank you for your advocacy and work to empower people who are credit challenged and are struggling financially. Let me ask you this. In the course of your advocacy, have you ever engaged those populations that you minister to, that you serve, in financial literacy, specifically on payday loans, to say educate those vulnerable populations about the difference between the interest rate if the product is used as it's designed, meaning that it's paid off in 2 weeks or 4 weeks, as opposed to rolling it over, in order to avoid that triple-digit APR, which it's never designed to be?
Well, yes, we have. To answer your question, we do have not only financial literacy classes for those who find themselves in that predicament, but we also, again, offer the small dollar 28% loan, micro loan, for those persons who are struggling. And a part of their getting the loan is going through the class.
And Mr. McDonald, I appreciate your sandbox approach, and I also appreciate your advocacy for clarifying True Lender to create liquidity in the secondary market with fintech. Let me ask you this. Without the small dollar loan program, without technical assistance grants, could you offer small dollar loans, or is taxpayer assistance essential in order to originate and service small dollar loans with interest rates below 36%?
I would not say it's essential. This is a specific business model that we've chosen as an organization, and a lot of organizations within the MBA have chosen to do so as well. So our profits are not at peer group levels. We've sort of...
Yeah, and I'm sorry, my time has expired, but what I worry about is that without taxpayer assistance, Mr. Sherrill doesn't have an alternative, and he's testified to that today. And so the only model that works is having the government compete and compete with private businesses and put them out of business. And you know, there's a limit to the amount that taxpayers can provide, and so we do need private capital to provide access to credit for some folks. And I yield back.
Gentleman's time has expired.